Hello, everybody, and welcome back to another episode of the Rogue Agent Answers. My name is the Rogue Agent. Some people call me David Lewis, and every week I answer one of the many life insurance related questions that I've received from clients, from email subscribers on the daily email list. Questions floated to me from across the interwebs, in the comments sections, which I know you're not supposed to read, or just interactions that I've had with people in real life over the past 20 years, which is a long time. And some of these questions I just scribble down on scrap pieces of paper. Some of these are stuff I've written down on my phone. Some of it is on Post-it notes scattered all over the office. And every week I answer one of those questions. So if you'd like to ask your question, drop them in the comments section or join my email list for more life insurance tips and advice at therogueagent.com. Also, keep in mind that nothing in this podcast is or should be construed as financial, investment, legal, or tax advice. In fact, nothing that I say in this podcast should be construed even as insurance advice, as I don't give individual advice blanket just across the internet unqualified to random strangers. So if you need any of that stuff, contact a licensed professional that you know, like, and trust, preferably someone licensed in your jurisdiction. And now for this week's question. Are there limits to how much I can borrow from my whole life cash value if I've got a big PUA rider pumping it up? Yes, you're going to be limited by the basically to the loan value of the policy, which is going to be probably a little bit less than the net surrender value. So I'd figure 1% to 2% is going to be held back in reserve, and that's to prevent overloaning of the policy. Some companies will do 5%, but it's 1 or 2% is typical. Life insurance companies don't want you to accidentally lapse your policy, so they build in a little bit of a buffer to prevent you from going a little too far. So a big paid up additions rider payment is going to help build up cash values very quickly, but again, there are always limits to what you can borrow. And you're always going to be constrained by the equity built up inside the policy. Occasionally, I've had people ask whether they could somehow borrow against the death benefit. And you can, in a sense, you can. I mean, those are liens that are under a different rider. On chronic illness riders, you get a lien against it. But just normal borrowing, like you want to borrow against the policy for cash to spend it kind of however you want, it's limited to the equity value that you put in, or that you pay premiums you pay into the equity value that builds up as a result of that. So that's what you can borrow. Next question. If I use a living benefit rider on my policy, does that reduce both the death benefit and the cash value, or just one? Yes, both. So a living benefit rider allows you to accelerate some of your death benefit before you die. And the carriers allow this because you're already terminal. I mean, maybe this sounds a little morbid, but you're going to die, right? So the benefit is going to be paid, and they're just advancing that payment to you ahead of your heir, instead of your heirs, ahead of your death. It's going to negatively impact the death benefit and cash value. So you have to decide whether it's worth it to you. So on the death benefit side, when you access a living benefit rider, like for a terminal illness, chronic illness, critical illness, so on, the amount that you withdraw is going to be subtracted from the policy's death benefit. Or if they use a lien method, it's essentially a loan against the policy. So for example, if your policy has a $500,000 death benefit and you take a $100,000 advance through the rider, then the death benefit is going to be reduced to $400,000. And the reduction that's pretty standard across most policies, right? So the rider is going to accelerate a portion of the death benefit for use during your lifetime, whatever is left of it. On the cash value side, for whole life insurance and universal life, a living benefit rider will also often reduce the cash value as well. So cash value is typically decreased proportionally to the amount of the death benefit accelerated. And the reason for that is that, and I know there's certain financial gurus who refuse to believe this, the insurance company does not actually, this ties into a totally different question, but the insurance company is not stealing your cash value when you die. There's this weird idea that when you die, you build up cash value in these policies, and then when you die, the insurance company steals your cash value and only gives you the face amount. That is, I don't know how to describe this, how stupid that sounds. But But your death benefit in a permanent policy, in a cash value policy, the death benefit is comprised of both cash value and what they call pure insurance or net amount at risk. So when you decrease the death benefit, part of what's coming off of that is your cash value, because your cash value is a reserve that's built up to help pay for the death benefit. So when you reduce your death benefit, part of that's going to be reducing your cash value, because that's what it's there for. So as your cash value builds up, it's actually becomes part of that future death benefit. And that's true for both whole life and UL policy. So, and a cash value is typically decreased proportionally to the amount of the death benefit. So, there's a couple of companies, as of this recording, and I have to say that because companies sometimes change their terms and conditions, but as of this recording, New York Life's living benefits rider explicitly states that exercising the rider, their chronic care rider, reduces both the cash surrender value and the death benefit. Penn Mutual, which is a different carrier, has a similar language, although theirs functions on a lien basis, not a cash surrender basis. And the Guardian is the same way. Mass Mutual, Northwestern Mutual. It's basically the same for every other carrier that I've ever looked at or done business with over the last, 20 plus years or whatever. Some policies might also apply an administrative fee. They may charge $100 or $200 or something. They're going to charge an administrative fee or actuarial discounts, right? So which is going to further impact the cash value. So, but if you need the death benefit and you don't have long to live because you're terminal, these costs I would say might not matter to you. And from my experience and what I've seen in the actual policy contracts, the fees tend to be relatively modest compared to the benefit you're getting. But again, the impact varies by the insurer and the policy. So some policies are going to prioritize reducing death benefit without significantly affecting the cash value. That's pretty rare. It depends. If you have a policy that has low cash values to begin with, or it's a death benefit focused policy, then obviously you're not reducing the cash value by much. But if it's an accumulation policy, yeah, most of them, all of them, I would say, are going to function where they're reducing the cash value. So some policies, it just depends. It depends on how the policy is set up and the type of policy. So term policies, which typically don't have a cash value, only see a reduction in the death benefit when the living benefit rider is used. But, and by the way, this is a rare benefit for a term policy to begin with. So you're not going to run into this one very often. But the insurance company does actually keep a cash value, a reserve on hand for the term policy as the policy owner. So that's actually there. So they're reducing the cash reserve of that. They're paying it out already. So they actually do have a reserve set aside. You just don't have access to it, which is another, again, kind of a side quest to maybe discuss in a different Q&A. But yes, term policies do have a cash value. You just don't see it. As a policy owner, it's just not available to you. It's, as far as you're concerned, it's zero. For chronic illness and terminal illness riders, the rider can generally be exercised only once. There's some exceptions to that, but generally it's a one-time use. And usually it's only triggered when the insured has a permanently disabling condition. I have seen them where you can go on and off, where it doesn't have to be permanent, but for most of them it does. The reduction to the death benefit and cash value is also, for the most part, permanent. Some of them let you repay the lien on the acceleration, some don't. So if it's a cash withdrawal, you can't. Payouts are generally tax-free, but might affect eligibility for public assistance programs like Medicaid. So that's how they work. All right, next question is, how does the dividend rate on my whole life policy affect the PUA rider's ability to buy extra coverage each year? Pretty simple. The dividend rate refers to the investment portion of the dividend. So there are three components to a whole life dividend. There's mortality savings, there's expense savings, and there's investment gain. And the dividend rate generally refers to the investment gain part of that formula. So as the dividend rate increases, there are more dollars to buy paid up additional life insurance. And this paid up additional insurance is effectively, it's basically it's a miniature single premium whole life policy. So it's basically, think of it as a single premium policy that's stacked on top of your face amount, on top of what they call the base policy. And that helps to grow your death benefit, obviously. And along with that death benefit increase, it gives you cash value, right? So cash value has to increase. And then that new paid up addition that's added to your base policy has its own dividend, and which in turn buys more paid up additional insurance. So it's a pretty neat feature. Obviously, it works in the other direction too. So if the dividend rates go down, there's less money available in the total dividend payment to buy paid up additions. Your death benefit doesn't grow as fast, and cash value growth slows down as a result. So unfortunately, you have no control over what the dividend payment or rate will be. This is basically this is the non-guaranteed element of a whole life policy. You just don't know what it's going to be from year to year. However, all the major mutuals, the old, what called the old mutuals, all of them that sell participating whole life insurance as a core product, and that's the big four. That's Northwestern Mutual, Mass Mutual, New York Life, Guardian, plus Penn Mutual, and I think there's Ohio National, or not Ohio National anymore. There's One America, and there's some of the smaller mutuals, but basically I would consider like the big four plus Penn. I kind of consider them the big five. They have paid dividends for well over 100 years, and in the case of New York Life and Penn Mutual, over 170 years. So yeah, they're pretty good about keeping their dividends stable and reliable, and they change. They do change from year to year, but they're pretty stable. And yes, there are periods of time when the dividend is raised or lowered by more than 50 basis points, which in the whole life insurance space, that's considered a huge move, a huge change. But in general, you can count on a healthy dividend being paid year to year and not have these big, huge swings up or down. I'm not saying it never happens, but for the most part, it doesn't happen. Most other life insurance companies have either converted to a stock company or mutual holding company. So the latter doesn't necessarily mean it's a bad company, like if it's a mutual holding company, but it's one step removed from a true blue mutual, right? The closer you can get to a pure mutual structure, the more the company culture tends to align with policyholder ownership. And that tends to be very good for policyholders and, of course, dividends. So anyway, yes, the dividend rate can and does affect dividends, right? It's a big part of it, right? So which in turn affects how much extra coverage you can buy each year. And anyway, I hope that helps. And keep sending me these questions. I will keep answering them, and I will see you in the next one. Okay, that's it for this week's question. If you'd like to add your question to the list, just drop them in the comment section or send me an email. And if you want more life insurance tips and advice, just head on over to therogueagent.com and sign up for my daily email list.